Good day. My name is Charene Nortier. I'm very pleased to welcome you to this webinar by the FSCA. Today's webinar is about the changes to the General Code of Conduct. The General Code was amended by Board Notice 706 of 2020, and this was published on the 26th of June of 2020. There were quite a number of changes, and I'm going to try and take you through them at a high level. So when we look at the definitions, we'll see that some of the existing definitions were amended, and they're on the left-hand side of the screen in front of you. And then there were a number of new definitions that were added. So if we look at the amended definitions, they include advertisement company, direct marketing, financial interest, and holding company. Then if we look at the new definitions, you'll see that it includes, amongst others, definitions on loyalty benefit, no claim bonus, plain language, service supplier, and significant owner. And I'm really not saying that the rest are not important, they are all of importance. And I would suggest that you familiarize yourself with them if you haven't done so already. If we start delving into the detail of the changes, in Section 3, a number of them were made. So Section 3.4 talks about the fact that an FSP is not allowed to create a false impression about authorization. This means that an FSP cannot use the fact that it has a license from the FSCA to give credibility to activities it performs that are not licensed by the FSCA. So if I use a very basic example, if you are a motor dealer and you sell second-hand motor vehicles, you cannot use the fact that you have a license by the FSCA to give your clients comfort about the quality of the motor vehicles that you are also selling. If you start taking this example through to financial services and financial products, then you will also understand that you cannot use the fact that you have a license by the FSCA to let clients feel more comfortable about those services that you render that fall outside the ambit of the legislation. Section 3.5 talks about independence, and there are a couple of things that if this is in place, you as an FSP are not allowed to call yourself independent. So if the FSP or a close associate of the FSP is a significant owner of a product supplier, the FSP or the associate is not independent. If the product supplier is a significant owner of the FSP or the associate, then again, the FSP or the associate is not independent. If the FSP directly or indirectly receives or is eligible to receive a financial interest from a product supplier, excluding certain financial interests that are defined further on, then again, you are not allowed to describe yourself as independent. And then the last one is that if any other relationship exists that gives rise to a material conflict of interest, then you are also not allowed to call yourself independent. Now, of course, the definition of material conflict of interest is in the General Code, and this is then important in your decision as to whether you can call yourself independent or not. Section 3, capital A, is the section that deals with conflicts of interest. You will see that we have quite a lot of changes to discuss here. So the first section of changes in Section 3.1a talks about fees, and there are a number of things to remember about fees. So fees have to be reasonably commensurate to the service being rendered. This means in practice that you cannot overinflate the charges and the fees, and you can also not discount them to the extent that they are not reasonable at all. So it is important to make sure that these fees are relevant to the service that is being rendered. It mustn't be too expensive, but it also cannot be discounted to the extent that it doesn't exist anymore. There are two sections that talks about clients and fees. So the first one is that clients have to agree to the fees in writing, and they have to understand how the fees are made up. And then the second one is that the fees can be stopped at the discretion of the client at any stage. Of course, this will have an impact on the service that you render to the client if the client stops the fees, but that is then a separate conversation that you have with your client. When we look at third parties, there are also requirements for the fees for third parties, and those requirements again pick up the concept of reasonably commensurate to the service that is being rendered. So that concept of reasonably commensurate, you will see that it carries through a number of requirements. If we then move on to the next section, then that talks about the FSP giving financial interest to a representative of the FSP. And there are some things that says this financial interest cannot be the following. So the cannot be the following is, in the first place, that you cannot give a financial interest based purely on the quantity of business that this representative is producing. It must also take into account how the representative is ensuring that the delivery of fair outcomes for clients is managed. Now, in the past, this talked about quality of business. So quality of business has now been replaced by this concept of delivery of fair outcomes for clients. You're going to see this idea of fair outcomes being carried through a number of further changes in the General Code again. And this, of course, talks to TCF. Then you cannot give a financial interest to a representative of the FSP if they are giving preference to one specific product supplier, if they can actually recommend more than one product supplier. And the same then, when they can recommend more than one product of a product supplier, you cannot give preference for one specific product of the product supplier. When the financial interest is determined, the FSP must also be able to demonstrate that it took into account measurable indicators. And those measurable indicators include the following things. So it has to include the minimum service level standards that are set in terms of clients. The delivery of fair outcomes of clients, you see the delivery of fair outcomes to clients again is prevalent and prominent here. The quality of the representative's compliance with Fais. So you cannot reward them for being non-compliant. You really have to take into account how compliant are they with the requirements. And you have to take into account whether it materially mitigates the risk of the representative giving preference to the quantity of business over the fair treatment of customers. You again see that concept coming through. When an FSP or a representative offer or receive financial interest, the financial interest must be reasonably commensurate with the service that is rendered. You cannot get paid twice for the same or a similar service. Actual or potential conflicts of interest must be mitigated, and the payment of the financial interest must not impede the delivery of fair outcomes to clients. You see the recurring themes. In Section 7, it talks about the information that the FSP must give to clients about the financial service that it provides. An important change is that this section applies to all FSPs, including direct marketers. So when you meet the definition of a direct marketer, and this is now important for all FSPs to go and check the definition of direct marketers. Remember, it was changed. So if you didn't meet the definition's requirements in the past, doesn't necessarily mean that you don't meet it right now. So please go and check, am I regarded as a direct marketer? And if the answer is then yes, you have to ensure that wherever a direct marketer is addressed, you must also have those requirements in place. The information about the financial services also says that the details of the disclosures to the clients must include their monetary obligations. So clients have to understand, if I sign up for this product or this service, what are the monetary obligations that I take on by signing on the dotted line? It must include the details of the services that the financial services provider or representatives will render to the client. The client must understand what are their rights. So as much as they have to understand their obligations, they must also understand their rights. And this is very important. FSPs must provide the information to the client in writing. Now remember, I said at the start, it includes direct marketers. So this then means that direct marketers must also provide this information to clients in writing. There is a new Section 7 capital A, and this specifically talks about forecasts, illustrations, hypothetical data, or projected benefits and past performance data. Now again, you're going to see this concept being carried through in other amendments as we carry on in this discussion. So this section applies to advertisements as well as when you are rendering a financial service. And there are provisions on statements that are being made about past performance of a product, as well as forecasts, illustrations, hypothetical data, or projected benefits. people like talking in illustrative terms when they explain a concept to other people. And what this means for you, if this is how you like to explain a concept, is that your illustration or your hypothetical data must be grounded in fact. You cannot just give information and create the impression that your information is factually correct when it actually isn't. So it is going to be important for you to check that your examples that you use in conversations with clients about their decisions must be based in real data. It cannot be based on hypothetical examples and they don't understand that you are merely making an example and it is not reliable information that you are giving them at that stage. Section 8 talks about suitability. Again, it very specifically says that this applies to all FSPs, including direct marketers. What is critical is that when you are engaging your client to understand what their financial needs are and what they want you to provide them with, you have to understand and establish the financial situation, their knowledge of the financial products that you are busy discussing, as well as their ability to bear the risk. Now, many FSPs and representatives specifically and their clients have built up a relationship over a number of years. And at this stage, they are both pretty confident that they understand the situation and they don't necessarily have to go into a lot of in-depth discussions when changes are being made to that client's product or portfolio of products. What this section says is you have to establish this again because things could have changed. And just because you understood it and you were correct in your understanding in the past doesn't mean that your understanding is still applicable. And I think what this last year has shown us is that there's been a lot of fluctuations in people's situations. And this could obviously have impacted on their ability to bear the risk. So where a year ago they might have been in a financial situation where they could bear the risk of a particular product, especially those products where there are no guarantees of the performance of the product. Right now might be they can't take that risk, or their ability to bear the risk has been reduced. So they can only bear the risk up to a certain level. And these are things that are important to take into account and to explain to your client as well. Another change that is quite interesting and critical is that where the client is a pension fund, a medical scheme, a friendly society, or an employer or an entity, the advisor, the representative who is dealing with that client, must take steps to reasonably identify the collective needs of the people that are being represented by this group client, by this pension fund, medical scheme, the friendly society, the employer or the entity. And I know again that very often the representative that you are dealing with from that group side will say, but these are the needs of our clients. And advisors tend to accept this because these are the people who are speaking on behalf of their members. But do yourself a favor and make sure that you do identify that this, what is being given to you as the need, it really is the need of those people that are being represented. You must also make it clear to the client if the FSP is unable to identify a financial product or products that will suit the client, and suggest that the client contact another authorized FSP. Sometimes the client has a need that is just beyond your authorization or your levels of expertise. In that situation, it is critical that you as an advisor then inform the client that you are unable to provide them with a product that is going to suit their needs, and that it would be best if they, for that need, contact another authorized FSP. I know this is tough to do, but it is in your and the client's best interests. On replacements, a lot of work has been done around replacements, and you are aware of the fact that on certain of the life insurance products, there is a prescribed replacement record of advice. But what is now added to the work that has been done around replacements in the past is that there's a very clear requirement that you must fully disclose the financial implications, the costs, and the consequences of this replacement to the client before that replacement is made. Section 8.4 has been replaced completely, and the new section says that you have to take into account client information and also their refusal to provide the information as requested. And then, if this is the situation, you have to alert the client to the limitations on the analysis. Because obviously, if you don't get all the information, there is going to be a limitation on what you can disclose to the client. And I think this last one is really useful for you to understand and to follow. If the client does not follow your recommendation, inform the client of any potential and possible risks that they face as a result of their actions, and record that. And we're going to be talking about records of analysis and records of advice just now. So remember this section. So in the record of advice, which is dealt with in section 9, it is important to understand that the client must provide the FSP must provide a client with a copy of the record of advice in writing. And this also applies to direct marketers. And now if we go back to the previous slide, and the last one says, if a client does not follow your recommendation, inform them of possible risks that they face as a result of their actions. And in the next section, we talk about the record of advice. Include this in the record of advice. If the client does not follow your recommendation, say to them, this was my recommendation, you didn't follow it, and these are the possible consequences that you may have. Because we know that clients will remember certain parts of the conversations and they are going to forget about other parts of the conversation. And in the future, when there is then a dispute about what the product actually performs as opposed to the client's expectations, then this record of advice is going to be really important and useful for you to explain, but this is what we discussed. This was what happened, and this is why this happened. And I gave you a warning about possible consequences. Section 14 and 15 deals in detail with advertising, and you can see that there are a number of sections around advertising that are now spelled out. Now, again, because this is so much, I'm not going to go through this in any level of detail, but it talks about concepts such as when it comes to advertising, the client includes the general public. So the client is there not just the specific person that you are dealing with, but in general, the public that are exposed to your advertisements. Some general principles that you have to adopt are explained, and then it says that advertisements have to be factually correct, balanced, and not misleading. You must also take the public interest into account when you are setting up and doing your advertisements. And your advertisement has to clearly identify the product supplier or the provider. The language of the advertisements have to be appropriate to your product and to your clients, and also to the medium that is being used. So the language that you use when you're doing a visual and an audio-visual advertisement is going to be a little bit different to the language that you use when you are doing a written advertisement, such as a publication on a website, on a Facebook platform, or any other kind of more static medium, print medium, for instance. You're not allowed to do negative opinion marketing, and you have to keep records of your advertisements. And this includes keeping records of the versions of the advertisement, so that if a client poses a question or there is a complaint about an advertisement, you can track it to the advertisement that was being aired at that stage or was in print at that stage that query or complaint came back. You have to have measures in place to stop unwanted direct advertising to clients, and that measures that you have to have in place is not allowed to bear a cost to the client. When you do comparative marketing, there are examples and requirements that you have to adhere to. There are also requirements around puffery, endorsements, loyalty benefits or bonuses, and the prominence of information in advertisements. And then we come back to the principles relating to forecasts, illustrations, hypothetical data, projected benefits, and past performance data. Remember, we spoke about that already, and I said, wait for this, it's going to come up again. So here it is very clearly part of the sections on advertising. On direct marketing, there are a couple of critical requirements. So the first one is that when you are regarded as a direct marketer, you must have the facilities to record all telephone conversations in the course of direct marketing. So it's not every single telephone conversation that has to be recorded, but if it is a conversation in the course of direct marketing, you must be able to record it. With that then, if you record it, you must have the ability to store and retrieve recordings. What you have to remember here is that if you are a direct marketer over a number of years, your software and your hardware that you use for these recordings may change. They update, they look different to what they looked a few years ago. You must have the ability to store and retrieve those recordings of a few years ago as well. So it's not enough that you can only store and record your current recordings. What do you do with past recordings? You must be able to retrieve them as well. So when you update your hardware and your software, it is critical to make sure that you retain the previous records and the method in which you can access those previous records. And if you can't do that, that you must have a measure in place that you can transfer past recordings so that it is compatible with the new recording software and hardware that you use. You must have the facility to provide the client with information in writing, and on request, you must make the recording available to the client as well. We have quite a number of sections in the Code of Conduct that deals with complaints management, and this starts off in section 16. And in section 16, you will see there are definitions that are very specific to the context of complaint management. And this starts off with client query, includes complainant, complaint, compensation payment, goodwill payment, member, rejected, reportable complaint, and upheld. So this is again important for you to go and take a look at, and if you haven't updated your processes and policies around this, it is a good time for you to now go and do that. Section 17 talks about the fact that you must have a complaints management framework. So the requirements are that you must establish a complaints management framework. What that complaints management framework must include: the allocation of responsibilities, the categorization of complaints. You must have a process to review and escalate complaints if it can't be resolved immediately. How do you make decisions about complaints that you receive? The record keeping, the monitoring, and the analysis of complaints. And then you must communicate with the complainants. You can't just receive a complaint and then there's dead silence. You have to have a process where you communicate with the complainant, A, to acknowledge the fact that you've received it, and then B, to give them feedback as to the progress and the process of the complaint. Section 18 talks about your engagement with the Ombud and reporting requirements. So you must be able to communicate with the Ombud, make information available to the Ombud, and then maintain records of your communication with the Ombud. Something that I find very interesting is the requirement that you must have the ability to monitor the determinations, the publications, and the guidance that are issued by the Ombud to identify failings and risks in your own policies, procedures, and practices. I don't know how many FSPs have this in place. So if you now think, oh, this is new, then please make sure that you include this in your processes and that you do take notice of the determinations that are published by the Ombud. And then you must also try to resolve complaints before the final determination or the ruling by the Ombud. So the Ombud is saying to you, and these requirements are saying, take responsibility for complaints and resolve them before we have to make a ruling. Obviously, on those ones where you cannot resolve it, the Ombud will make a ruling. But it is in your best interest to try and resolve it before the Ombud has to make a ruling around the complaints. Section 19 talks about the ability to report complaints to any relevant authority or the public as required by the registrar. So not only must you be able to report to the Ombud on certain issues, but you must also be able to report your complaints to any relevant authority as the Registrar of Financial Services may publish. This is the last slide, and this is a really important slide. What I've done here is I've summarized some of the changes in the amendment to the General Code and the effective date. Now remember, at the start we said that these amendments were published on the 26th of June. Now, some amendments come into effect on the date of publication. So those obviously I haven't listed here because the date that this amendment was published, those ones came into effect. So the definitions, for instance, came into effect on the date that the amendments were published, so on the 26th of June. But if we look at the second column, the column with the heading of section, that is the section in the General Code of Conduct. So these are the dates on which these sections come into effect. So the majority of them come into effect 6 months after the effective date. This means that they are coming into effect on the 26th of December. So Section 3, capital A, which is conflict of interest, Section 7, Section 14, 15, 16, and certain sections of Section 17, and then Section 18 and 19, all come into effect on the 26th of December. And then there are a couple of subsections of Section 17 that come into effect 12 months after the effective date, and that means that they go into effect on the 27th of June 2021. So this brings me to the end of this webinar. I hope that this was useful for you and that you will be able to make the changes to your business practices and implement them. I want to also extend an invitation that if you have any questions and you're not sure how this applies to you, or you're not sure whether your interpretation is correct, that you are welcome to engage the analyst looking after your FSP and have a conversation with that analyst. And they will be able to assist you to understand the implications for your business and help you to make sure that you navigate these requirements correctly. So finding out who your analyst is quite easy. If you go onto our online portal on the FSCA website, so it's www.fsca.co.za, and you then go to supervised entities, you will be able to log onto the system, and then you can see who the analyst is. All the best and good luck. I hope that you will implement this all very successfully. Thank you so much for participating in this webinar.